For traders that have emailed and asked, the links for the free downloads are in the description box below. Just click on the link or copy and paste and put that in your browser. The 4-step method to high performance trading and the 7-step daily routine for high performance traders create the rituals, the mindset, and the winning attitude to master the markets. Bulletproof yourself with your daily routine and your habits. Force yourself to be getting better, 1% better every single day. How good can you get, traders? Again, the free downloads, the links are down below. They're both free courses. Let's get started. Good day, traders. Stacey Burke from Stacey Burke Trading. Answering some questions from traders, and again, thank you for the messages and emails. We're going to look at a couple of situations with the markets to hopefully simplify and clarify. Some traders still having some frustration. I emphasize to step back and really start to identify setups and not get caught trying to buy and sell the high all the time. That's a different mentality than focusing on what a setup is. Coming to the screen because it's London Open and trying to sell it at the high or buy it at the low is what will get you caught as the first mouse, or get you caught and get frustrated in an impulsive, fast move to the high or to the low. Step back, pay attention to time, understand the rotation, the time rotation, 15 minutes hourly, but coming back to some simple concepts, the high and the low of the day. A couple of traders messaged me, said, how did you take the gold trade? You weren't at the high or low of the day. Now, if you went back and watched the video that I put up yesterday, I clearly defined that we had traded through the previous week's high with 3 peaks. I made a very clear indication that this market had a peak formation high, and we had put in peak formation low on the Tuesday at 50. We've also talked about 3 levels of rise. Now, if you notice that Wednesday's low was traded into on Thursday, that low, which again is a number level. All these highs and lows, when you understand them, they respect number levels. So if they're not exactly at a number level, that's because it locked in a peak formation at a quarter level or a round number level. But then the next target will be the number level outside of that previous day's high or low, which is a quarter level, 25 to 50 pips. So in Asia, we have respected that Wednesday's low. They traded through it on Thursday and pulled back, and in Asia proceeded to work down into the low before going up 50 pips. Now that low becomes our low of the day. That is our low of the day now. Now we went up and put a peak formation in the gap time. That becomes our high of the day, which is at the quarter level. Now, we also spoke about 3 levels of rise. A question the other day from somebody who was frustrated with me saying, where does that start from? Does it start from double zeros? Does it start from the previous day's high? Or does it... 3 levels of rise. Measure it. That's the low. On a normal day, that will be 3 boxes of 25. And what that means is that we have a peak formation low. So we have 1 level of rise, 2 levels of rise, and we're into the 3rd level of rise when Europe starts trading. Now, understand what's happened here. They've gone up 25 pips. Anybody trading above double zeros now is buying or selling up high. So they can be selling up high, but we're selling it prior to the London session against the break long. So you're counter trending a breakout trade from the previous day's low, and again outside of the timing window. So I really specifically emphasize the timing because that's where you'll understand the importance of when you can take these trades. So coming back to this, 3 levels of rise. Now, if you take the low of gold, 17,862. I dropped the last number at 62. So if we had 75 pips to that, that gives us to 932. 932 is 75 pips. That's 325 pip boxes. Now we're in, just in simple terms, 1, 2, and we're into the 3rd level. When we have the close of our first hour of Europe, it makes a high. I've said the first hour on most days will make a high and a low. In some instances, the first hour can be the trade, and we will look at an example of that and under what circumstances that can occur. So some traders took the first engulfment right at the beginning of the London Open. Now, as I mentioned, I want you to have a think about this. We're still in an uptrend. We're still in an uptrend when the London session starts. So the London session starts on this little bull candle, the bear candle right here. I'll just put a little arrow there. I know some traders have asked for me to highlight my cursor. So remember, that's the end of the first hour. Now I want you to think about this. We're in an uptrend. This bar, it doesn't even engulf the high bull. But also I want you to just have a think about this. We have hourly traders in the market now. They've broken the high of the previous hour. When London opens, I want to see them break the high. I don't want to try and sell the high. I want to see them break the high and reverse. We want to see hourly traders get triggered into the markets. 15-minute traders, 5-minute traders, other time frame traders, possibly 4-hour traders now. We have them in on the break of the previous hourly bar. This initial breakdown in the first 15 minutes, so we're 5, 6, 7 minutes in. This is where the break in structure occurs. Okay, that's the beginning of the trade for me. Now we're looking at a pump and dump. At this stage, we're still in an uptrend. Okay, but if you buy here, you're buying high at the high of the day. Now, we have not broken a previous day's high or low, but we have broken the peak formation high of the day that was made in Asia. And we're making new highs. The first 15 minutes breaks out and closes as a breakout candle on the 15-minute chart. So now we have 15-minute traders in, 5-minute traders in, possibly breakout trader, 1-minute traders. But that's the first 15 minutes. And you've heard me say this. False move at the beginning of the equity session, taking traders into the wrong direction. But now we also have a break of an hourly high. The break of an hourly high. That's important. I want to see the hourly trader get triggered. One push, second 15-minute bar opens. 2 pushes, engulfment of the high bull. 3 pushes, engulfment, M structure, and the breakdown, and there is our triple top micro M structure for a starter. I'm in the market. I'm inside. Now, I also have said, when I get a breakout candle, a pop-up, back into that breakdown, that is where I will add positions. Anywhere back to the low of that bar. Bang, 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 bang. As soon as it breaks down, I'm done. So we have 3 levels of rise. We're at the high of the day. The first hour makes a new high. London opens and goes vertical and triggers breakout traders. Then triple top engulfment back inside. A pop-up above the numbers. Above the numbers. Another great question from a trader. Do you still focus on the numbers? It's always about the numbers. Always. I'm always targeting numbers. I want to get in at 50. It doesn't get there. It reverses before we get to 50. it struggles to get there. Now come back to what I said initially. My thesis was that we could trade back up into the previous week's high where we have triple peaks from this week, day 1, day 2, day 3, locking in the high. My thesis was that this market could break down. This could be the high of the day. We could break through the low of the day and pull back and roll over in the U.S. session to go down to the low, towards the low of the week. Now, knowing that though, I take this initial trade and I'm locking in the money. I'm not worried about holding on to get the high of the day and hold on for 100 pips. I want to lock it in and I'll take a trade in the U.S. if the same setup occurs. We come down to the low of the day. This is our low of the day. We traded inside of the low of Wednesday that was locked in on Thursday. They went up 3 levels of rise in the first hour, put a high in, they pop the top, pull back, and go vertical. That's the trade. Done. That's it. We come to the U.S. session, and we've broken a daily low. We've broken the daily low. We have a daily high and a daily low. So again, the question from traders were, well, gold didn't break any levels. Yes, it did. It broke the high of the day of Europe, and it broke the low of the day of Asia. This higher high in the hour prior to the U.S. session is your insight into the direction that they are going. This is the beginning of the dump into the open of the session. This is the beginning of the dump through the low of the day. So they trade down into the low of Asia, put a slightly lower low in place, and again you'll notice now traders selling this are selling down into the low of the day. Now, count the pushes. 1 push, 2 pushes, 3 pushes into the first 15 minutes of the session. Right here. Engulfment, bullpen hammer, second bullpen hammer with a W at the low of the day. High of day. Okay, back in London. London puts the high in place. They go down to the low of the day. The U.S. session opens the 12 candle window and begins the reversal back up. They take out the high of the day. Now, when we have a market that reverses inside and takes out the high of the day into the U.S. session after 3 peaks, and we've taken out the high of the previous week, I am not looking to short this market. There was news at 10 o'clock U.S. time. So understand the concept there. Even though we're back at the high of the day, we have news. When the news candle goes vertical into that breakout after the reversal through the high of the previous week, and we have a triple top on a Friday, this is a high probability that this market will continue to go back in the long direction. At this stage, I wasn't even looking at this pair, but the initial move from the low of the day, this higher high is your gift. That's the higher high, the break in structure, and then dumping it into the low, getting traders to sell it into the low before the explosive short squeeze back up through the high of the day. So again, timing-wise, 7 minutes. 7 minutes. And a reversal forms a pin on a 15-minute candle. You have to be understanding time. 15 minutes, false move. Let the market break out and trigger other time frame traders. This engulfment at the beginning of the first 15 minutes of London doesn't trigger anybody in the market. This is not a trigger. This is an uptrend. This breakdown and then the vertical move is the beginning of our pump and dump and our break in structure. That's our micro trend line break, a retest of the high, a triple top, second 15-minute bar, our engulfment of the high, the failed breakout, the breakdown pullback, and the vertical explosive move back to the low of where that move began. So space, 3 levels of rise, peak formation high, peak formation low, false break, new high in the first hour, the false break at the London Open, the vertical move, and then working into the low of the day, the break in structure. First 15 minutes, 7-minute pin bar reversal for the explosive short squeeze back through the high of the day. So understanding that you're not always going to have them paint a line for you to trade back to. You have to be paying attention. The market broke through the low of Wednesday and reversed and then traded down into it and went vertical. A 50 pip move. That's 3 levels, 75 pips from the low, 25, 25, and we're in the third level. Okay? Can also notice there's peak formation above 25. We're trading back up into the previous high of the week. Okay, the high of the week from the previous Thursday. Day 2, day 3, Thursday, triple top. Thesis was sell high for the breakdown and the rollover back down. But taking the money, we get to the U.S. session and it's a short squeeze. They're jamming them in down low. Another question from a trader. You haven't been putting up any trades on the NASDAQ lately. I follow 10 instruments. I'm looking for the pair that gives me the best trade. There are times when the index is maybe moving all over and show lots of volatility, but during the U.S. session, they may not be what I consider to be ideal. Look at these wicks. That's not an ideal setup. So when I'm looking for stuff, this is ideal. We're up at the high of the week. Did I take that trade? No. I may have been taking something else. So I'm not necessarily just focused on trading one instrument. I'm looking for the simplest, easiest setup for me to recognize. That's a really simple setup for me to recognize. Goes vertical, 3 levels. Consolidation, higher. Equity market opens, pops the top. False break reversal. Above the quarter level, I have 3 levels. I've said this. I want a 75 pip box for a 50 pip vertical move. Sometimes depending on the setup, if it's rolling over out of a tight consolidation at the high of the week or the low of the week, you won't get a 75 pip box. You'll get a 50 pip box. Again, different setup. So, coming back to some simple concepts, timing, knowing what your setups are, but then waiting. Let somebody get caught. Let somebody get caught. First mouse gets caught. Let somebody get trapped on the break. Look for the false break. That's the easy money. Oil was slightly similar to some degree. We didn't get 3 levels of rise until the Europe session. So coming back to previous day's highs and lows, we don't have any of those broken. We have a low of the day put in place in Asia. In the first hour, peak formation low. This is West Texas. Peak formation low. They put a low in, not a high. They put a low in and go back up through the high of the day. They're going higher. So again, this is an example of where traders, just because something goes to the high does not mean that you just sell this. That is not for me, that is not a setup. So coming back to what are your setups? Not just, it's at the high, I'm going to sell it. What is the setup? What are you looking for? 3 levels of rise. Well, at least give this room to get up towards 50. If you're looking for something. Because London's open London's already open. London's going higher. So London opens and goes higher. Right? We're in a peak formation low in Europe and it's going higher. This market is going up. If it put a peak formation high in and we pop the top of the first hour, that's different. But they went down and put a low in, and now we're looking at 3 levels possibly of rise. Now, if that's the case, in that third level, similar to gold, we want to see trap volume. Now gold traps volume and goes higher and pops the top. if somebody was trading oil and looking for the short in London, now you have to be thinking, okay, if that hour is going up, the London hour, the first hour put a peak formation low in, and London is going up minimum of 1 hour to the high, right? 1 hour. The second hour should be trapping volume because we're going higher. We're not false breaking out. We're going higher. Point being, when you see this type of situation, you have to understand the timing of it. 1 hour to the high. Now the next hour is going to hold the high and work the volume up. So if that's the case, towards 30 to 45 minutes in that next hour, we may see something. 45 minutes in, we see a reversal trade from London putting the high of the day in, second hour holding it up. At the end of that hour, third hour, they drop it down, second hour after London. They go back to the high of the day. Now, if traders were trading the high and low of the day, that's our new high of the day. So when the day starts, we have yesterday's high and low. Asia puts a low in. London puts a high in. They go back up to the high of the day. They work the high in the gap. It breaks down in the gap time. It breaks down. So if you were trading in here, obviously there was a great opportunity. But now, heading into the U.S. session, we have a broken down market. It goes vertical through the low of the day. We are now in a broken down market. What do we want to see when the New York session opens, the equity market opens? I want to see a peak formation high for a continuation trade down, the low-hanging fruit trade. So again, the market comes down and puts a low in place. First hour puts a low in place. We have a high of the session. We have peak formation high at 50 from the move down. 50 may be a level. They sold off there once and put a peak formation in. We may get an opportunity somewhere up 3 levels into 50. Second hour opens. In that first 15-minute bar, we get 1 push, 2 pushes, 3 pushes. Now, for those of you who can't see, just open up your chart. This is a 1-minute chart. So this is really important. I'm looking at 60 minutes for the trade. What that means is I'm not worried about all this stuff. So when people talk about it's too volatile, I can't read the 1-minute chart, I'm focusing on the hour. Okay, and this is what I'm looking for. I want to see something go vertical into the move down so I can sell it back down to the low. That's it. That's the low-hanging fruit. It's already broken down. So we want the pop-up and the sell. Second 15-minute bar, right towards the end of that first 15-minute bar, we get our 3 levels of rise for a sell high opportunity. The equity markets open, pull back, and continue that move down. So we had a 50-pip move down at the New York equity market open, new hour, pull back, and a rollover for a 100-pip move down again. Low-hanging fruit, continuation trade with the trend in a broken down market. So somebody mentioned yesterday, is it really sustainable? 50 pips a day, that's 250 pips a week, and that's 1,000 pips a month, that's 12,000 pips a year. Is that really sustainable? I don't focus on any of that. I focus on one trade at a time. That's it. I focus on one trade at a time, and I am looking for a best trade setup. You have to train yourself to identify what your best trade setups are, what you trade the best. You have to control yourself. You can't control what the market's going to do, but I'm going to tell you what, there's more than 50 pips a day every single day. I've been following these markets for 20 years. There's 50 pips a day. Are you going to get every single one? I don't know. I have no idea. Is it possible? Absolutely, it's possible. But you have to, it's you. There is no limits. It's you who puts the limits on yourself. It's you who will engage in impulsive, irrational behavior. It's you that will over-leverage. It's you that will move your stop. It's you that will average into a losing trade. It's you that will not get out of a losing trade. It's you that will get out of a winner too soon. It's you that will not have enough size on the best trade setups that are your huge winners. You'll have too much size on losers, all the things that will cause you from achieving the success that you want. And I know that firsthand. So is it sustainable? I can't answer that for you. Only you can answer that. Is it sustainable for me? I don't focus on what's sustainable. I focus on what I need to do every single day, and that is execute my best trade setups. I need to lock in the money. I need to manage my risk. I need to have a stop loss, an entry, and a target. People want to trade live, and they want entertainment, and they want to watch somebody else do it. I want to do it. That's it. For people who are serious, they want to do it. Watching will not make you better. Watching doesn't help you control yourself. You think you watch one trade, and all of a sudden you'll figure it out. You have to have a process. You have to have a process that you go and approach the markets with every day. I've made it very well known. I'm heavily biased to the downside. I like to look for shorts. So it's very easy for me to now look through pairs really quickly to identify what the best trade setups are. So, coming back to the NASDAQ and the S&P, the long term of those markets is that they're bullish. The indexes always go up. So I'm only looking at those indexes when we're in a down template or I have the opportunity for a sell high. Do I want to trade it when it's going to be in a wiki trading range volatility 3-hour window and then move later in the session? No, I do not. I want high of the week opportunities. That's it in a broken down market. So, again, although you may think that you're going there and trading setups, don't get caught chasing movement. Have a thesis. Draw your lines. Pay attention to the time. Know exactly what you're looking for. Look for people to get trapped. Look for false breaks. There's 3 types of trades. Trend trades, reversal trades, and trading ranges. That's it. That's all there are. I call the trading ranges session scalps. The other ones are the reversals. If it's first red day, first green day, we can get parabolic moves that are very, very big, 300 plus pips, especially on gold, oil, and indexes. Obviously, we can get 3-day runners on the major pairs, especially coming out of 3 weeks of rise or fall, which typically will align with the monthly cycle. So hopefully you got value from today's video, traders. There are lots of things to consider. But the more you can simplify that process every day and not try to go and trade the moves and get pips, the more you understand yourself and what you're actually trying to do when you go to the screen each day. There's no more anxiety. There's no more restlessness or fear, the FOMO, the fear of missing out. You know exactly what you're looking for. And when it's not there, you don't feel compelled that you need to trade. You walk away from the screen because when it's not a best trade setup or when it doesn't resonate with what looks like normal is when you have 3 levels of rise for me for a short trade. That could be 3 days, day 1, day 2, day 3. It's the same thing. High of the day if I want to short something. So, I just try to hopefully pull back and there's no, being bluntly honest, it's you have to work on what you need to do so that you can do it in a lifetime. Watching someone chasing moves, getting pips, they're not all the same thing. Scalable, reproducible setups takes work. You need to keep working on it until you find the 3 or 4 or 5 best setups that you have, and then a process that helps you identify them. I mean, the time of day is the easiest thing to nail things back. Keeps you out of the junk. That's it. It is what it is. So hopefully that makes sense. That's my rant. Some people have chewed into me on some emails, and I'm just like, okay, well, you have to do what you need to do. You can't control anything else other than yourself. So have a great weekend. Really appreciate and grateful for, I love seeing people get great results because I know how frustrating this is. And for those of you who some people don't like my attitude. Look, you weren't there when I was sitting in the corner bawling my eyes out, 10 years in, blowing up accounts and everything else. So I'm there. I'm giving you everything that I do, and it is what it is. So keep it simple, make it work for you, because it's doable. Have a great day, folks. and may the markets go with you.